With ASML stock, riding this 3-day winning streak and flashing these strong buy signals just days before its April 15th earnings report, are you looking at an undervalued AI gold mine? Or, is this just a massive value trap waiting to spring on unsuspecting retail traders?
That is honestly the multi-billion-dollar question right there.
Hmm.
We are looking at an asset that is simultaneously being heralded as like the monopoly of the century, while also flashing some of the most classic textbook technical warning signs of near-term exhaustion.
Yeah.
It's literally pulling the market in two completely different directions.
Which makes it the perfect topic. So today is April 12th, 2026. We are looking squarely at ASML Holding NV, and we've brought a pretty massive stack of sources to the table today.
Yeah, we've got their latest financial statements, the raw technical indicators, insider trading reports, and even some macroeconomic geopolitical data.
Exactly. And our mission today is to really just cut through the noise, unpack the actual mechanics of what is happening under the hood and decode whether ASML's trajectory is actually sustainable.
Because it's so easy to just get swept up in the hype.
Oh, absolutely. And really quick, since we rely entirely on your feedback to steer these deep dives, make sure to like the video, subscribe to our YouTube channel, and it is absolutely compulsory that you drop a comment below with your own verdict once we lay out all this evidence.
It's vital to have this debate right now, especially because the broader market tends to just hear the word AI, hear the word chips, and they just blindly throw capital at the screen without really looking at the underlying physics of the trade.
Yeah, without looking at the actual business. Let's start with that cold, hard financial reality, because before we can ask if a stock is a trap, we kind of have to look at the foundation, I guess.
Right.
And looking at their full year 2025 performance, the scale is almost hard to wrap your head around. Total net sales hit 32.67 billion euros.
Which is just a staggering leap from 28.26 billion the year prior.
Yeah.
And it's not just hollow top-line revenue either.
Yeah.
Their net income came in at 9.61 billion euros. But, the metric that fundamentally separates ASML from almost any other hardware manufacturer on the planet is their gross margin.
Okay.
It is sitting at 52.8%.
Wait, I need to pause you right there. Over 50% gross margin on physical, incredibly complex machinery.
Yeah.
That is usually like software as a service margin territory. You just don't see that in manufacturing, where you have to physically build, ship, and maintain these massive pieces of industrial equipment.
You don't, not unless you possess absolute pricing power.
Mm-hmm.
And that's exactly what that 52.8% margin illustrates mechanically. ASML isn't competing in a crowded market where they have to, undercut competitors to win bids.
Because nobody else does what they do.
Exactly. They manufacture extreme ultraviolet EUV lithography machines. Without getting too deep into the physics here, these machines use lasers to vaporize droplets of molten tin.
Which sounds like science fiction.
It really does. It creates this plasma that emits light at a specific wavelength, which then prints microscopic circuits onto silicon wafers. Nobody else on Earth can build these at commercial scale.
Wow.
So when ASML tells a semiconductor foundry what a machine costs, the foundry just pays it. That pricing power is exactly why they generated 11.1 billion euros in free cash flow in 2025 alone.
And looking at their balance sheet, they are basically sitting on a dragon's hoard. They have 13.32 billion euros in cash and short-term investments and only like 5.51 billion in total debt.
Right.
They could pay off every cent they owe tomorrow twice over and still have billions left over to operate.
Exactly. But the true crown jewel in their financial stack isn't the cash sitting in the bank today, it's the backlog.
Yeah.
ASML is sitting on a 38.8 billion euro order backlog.
Just to visualize a 38.8 billion euro backlog, imagine an incredibly exclusive, world-renowned restaurant, right?
Okay, I like that.
It does not matter if you show up to the host stand tonight with a briefcase literally full of cash. They are fully booked for years. You cannot get a table.
No chance.
That's the reality for ASML's clients. Customers are essentially, taking deli numbers and waiting in line for machines that haven't even been built yet.
And that kind of locked-in future revenue, it provides this immense psychological and financial safety net for corporate planning. It mechanically explains their recent capital allocation decisions, too.
Like the buyback.
Yeah, in January 2026, management announced a new 12 billion euro share buyback program running all the way through 2028. When a company with this much cash flow authorizes a massive buyback, management is basically looking at their own balance sheet and deciding that taking their own shares off the open market is the most efficient use of their capital.
But wait, I kind of have to challenge that premise.
Sure.
Because the stock is hovering near all-time highs right now.
Yeah.
Buying back stock at the absolute peak doesn't always signal confidence. Sometimes it signals, I don't know, a lack of imagination.
That's a fair criticism.
If they have 13 billion cash, why not double down on R&D? Is a buyback at 12,270 euros a share actually smart capital allocation, or is it just corporate hubris?
It's a highly debated point right now. The counter-argument, though, is that their R&D budget is already fully saturated.
What do you mean?
Well, there is a physical limit to how many physicists and engineers you can throw at next-generation lithography before you just hit diminishing returns. They're already developing the High-NA EUV technology. Once R&D is fully funded and the dividend is paid, sitting on excess cash actually hurts shareholder returns due to inflation.
Oh, I see.
So retiring shares reduces the total float, thereby increasing the earnings per share for the remaining shareholders, like, the people listening right now.
Okay, so the core business is just an absolute juggernaut. They have a monopoly, massive margins, an unprecedented backlog, and this huge 12 billion euro buyback. But here's the massive disconnect.
Let's hear it.
If the foundation is essentially flawless, why are the architects running for the exits? Let's talk about the price action and the insider selling.
Yeah, the price action itself tells a story of extreme momentum. Over the last 52 weeks, the stock saw a low of 548.90 euros and a high of 1,312.80 euros.
And today, it's trading around 1,270.
Exactly. It more than doubled in a single year.
Yeah.
And when an asset moves that aggressively, human behavior and risk management start to kind of override pure fundamental analysis.
Which brings us to the SEC filings and the actual insider activity.
Mm.
Over the last 90 days, we've seen a net sell-off of roughly $6.83 million by company insiders.
Right.
And it's not just like mid-level managers cashing out their bonuses. CEO Christophe Fouquet and CFO Roger Dassin both sold shares in early February at around 1,206 euros.
They did.
Now, I know the standard Wall Street excuse is always routine tax planning or, portfolio rebalancing, but I really have to push back here. If I'm on a cruise ship and I see the captain and the chief engineer quietly strapping on life jackets, I don't assume they are just testing the buoyancy for fun.
That's a great visual.
Right. How can we be so sure this isn't a panic sell before earnings?
It's a completely fair question,
Yeah.
and it's exactly why retail investors get so spooked when they read those filings.
Mm.
But we do have to look at the mechanics of executive compensation. When a stock doubles in 12 months, an executive whose net worth is heavily tied up in company stocks suddenly finds themselves massively overconcentrated in a single asset. Fiduciary advisors will literally force them to diversify just to mitigate personal risk.
That makes sense.
Furthermore, when stock options vest, executives are hit with a massive income tax liability. They literally have to sell a portion of the shares just to pay the tax bill on the compensation they received. In the context of a company generating over $32 billion in revenue, a $6.83 million insider sale is, statistically speaking, minuscule.
Okay, I understand the mechanical necessity of the tax selling, I'll give you that.
Yeah.
But it's not just the C-suite.
Right, the political side.
Exactly. We also have U.S. congressional trade reports in our source stack today. Representative Ro Khanna and Representative Michael McCall both reported selling ASML shares in February at prices between $3,350 and $4,406.
Yeah, that definitely caught people's attention.
And to be perfectly clear to everyone listening, we're not taking political sides here, but strictly looking at the market optics. When members of Congress who sit on oversight committees and have access to closed-door briefings regarding international trade, when they start dumping a stock, that adds a whole new layer of anxiety for the everyday investor.
And that anxiety is grounded in logic. The U.S. government has been actively tightening export controls on advanced semiconductor equipment going to China.
Right.
Lawmakers involved in foreign affairs or technology oversight often have advanced visibility into regulatory shifts.
Right.
Whether these specific trades were driven by that knowledge or simply by their own financial advisors rebalancing a portfolio, the optic is undeniably negative for market sentiment. It signals regulatory turbulence ahead.
Which is a perfect segue, because the average retail trader isn't reading congressional disclosures every morning with their coffee.
No, definitely not.
They are logging into their brokerage account and looking at the technical charts. And right now, the daily charts are screaming strong buy. So are the charts blinding traders to the underlying risks?
Well, the algorithmic indicators are incredibly bullish right now, yes. Let's break down why. The MACD, which is the moving average convergence divergence, is currently at 25.78.
For the listener who maybe isn't a day trader, what is the actual mechanism behind that MACD number? What is it actually tracking?
Sure. MACD tracks the momentum of a stock by measuring the distance between its short-term price average and its long-term price average.
Okay.
When the short-term trend line crosses above the long-term trend line, it flags a surge in upward momentum. That 25.78 figure is a textbook bullish crossover.
Got it.
Furthermore, the 50-day moving average is at 11,185.30 euros, and the 200-day moving average is at 11,175.90 euros. Because the current price of 12,270 is sitting comfortably above both of those historical averages, any trend-following algorithm in the market is registering a solid buy signal.
And the charts also show us exactly where the current battlegrounds are, right?
Yes, they do.
We have key resistance right overhead at 12,280.20, and then a major structural ceiling at 5,282.70. Conversely, if it drops, there is a strong support zone between 11,172 and 11,193 euros.
Correct. But this is exactly where the trap is potentially being set. You have an upward trend approaching a massive structural ceiling. This is where we really have to look at the volume divergence.
Yes, this is the catch. The data shows that the average 3-month trading volume for ASML is 1.81 million shares. But on this current 3-day price rally that everyone is cheering about, the volume actually fell.
Yep.
The number of shares changing hands is dropping as the price goes up.
Which mechanically indicates a severe lack of conviction. Let's think about why price moves. Price moves up sustainably when large institutional buyers, like hedge funds, pension funds, when they step in and aggressively accumulate shares.
Right.
If the price is climbing but the volume is shrinking, it means the heavy hitters are sitting on the sidelines. The stock is essentially just drifting upward on low liquidity.
So is this volume divergence basically like a car coasting up a steep hill? It looks like it's still going up, the dashboard says you're moving forward, but the engine is totally out of gas, you're pressing the pedal and getting nothing.
Exactly.
And eventually the forward momentum dies and gravity is just going to take over.
That is the perfect analogy. And to compound that problem, the 14-day RSI, the relative strength index, is sitting at 72.5.
Which puts it officially in overbought territory.
Exactly. The RSI calculates the speed and magnitude of recent price changes. When it crosses 70, the math is essentially waving a red flag, indicating that the stock has moved too far, too fast, and is seriously due for a pullback.
And this exact scenario, right? Overbought indicators, a car coasting uphill on dropping volume, all happening right at the edge of a massive resistance ceiling of 1,282 euros. This leads directly into the great debate.
The big question.
Is ASML currently an undervalued AI monopoly, or is this the absolute textbook definition of a value trap? Let's unpack the valuation. Roughly 79% of analysts still have a buy rating on the stock, with an average target of 1,414.13 euros.
Right.
But the PE ratio is sitting between 46.5 and 51.3 right now.
Which is where the debate fractures. If you are a strict value investor comparing ASML to its own historical baseline, it is undeniably overvalued today. Over the last few years, ASML's historical fair value usually hovered around a 36x earnings multiple.
Yeah.
At 50x, you are paying a massive premium for the exact same underlying business.
But the bulls would argue you can't evaluate ASML in a vacuum. You have to look at the neighborhood.
Precisely. If you look at the current peer average in the semiconductor sector, the multiple is around 52x. So by sector standards, ASML is technically undervalued.
Which is wild.
It's trading at a discount to its peers, despite arguably having a better monopoly than any of them.
But this dynamic right here is exactly how retail traders get slaughtered. They read the headlines about the AI boom, they see that 79% buy rating, and they just log into their brokerage.
Got blind buying.
They see the price ticking up toward that 4,282.70 resistance line, and they buy the breakout. They completely ignore the overbought RSI and the fact that the volume is hollow.
And what happens mechanically? The algorithms that drove the stock up on low volume hit that resistance line and immediately trigger automated sell orders to take profits.
Wow.
Because there are no big institutional buyers stepping in to absorb those sales, which, again, the low volume warned us about, the price collapses rapidly back down toward the 1193 support zone.
Ouch.
The retail trader who bought the top of that short-term cycle is instantly trapped in a lose-good position. They panic, and they sell at the bottom.
And it is not just chart mechanics that can trigger that collapse. We have real, brewing, fundamental risks underneath all this hype.
Right, the labor issue.
Our sources show 1,700 planned job cuts, which is already sparking concerns about labor unrest in the Netherlands. If you have a 38.8 billion euro backlog and customers are practically begging for machines, why on earth are you firing 1,700 people?
Well, because revenue does not equal efficiency. The company scaled up its workforce massively during the post-pandemic chip shortage. Now, as a broader semiconductor cycle kind of normalizes, management is trying to aggressively protect that 52.8% gross margin.
Okay, but still.
But you are absolutely right to highlight the risk. EUV lithography is perhaps the most complex manufacturing process ever commercialized. You cannot simply replace a disgruntled or striking Dutch engineer with a new hire off the street. Any labor disruption directly impacts their ability to clear that 38 billion euro backlog.
And we really cannot ignore the geopolitical elephant in the room, the export curbs to China.
Yeah, it's huge.
This isn't just a political talking point, it's a mechanical restriction on their revenue pipeline. The U.S. government is actively pressuring the Dutch government to revoke export licenses for ASML's advanced machinery. But how exactly does the U.S. enforce restrictions on a company based in the Netherlands?
It all comes down to the supply chain. ASML's machines rely on thousands of highly specialized components, some of which contain intellectual property developed in the United States.
I see.
The U.S. government leverages that IP to enforce what's called the Foreign Direct Product Rule. Essentially, they tell ASML, look, if your machine uses even a fraction of our technology, you cannot sell it to a restricted Chinese entity without our permission.
Wow. And China is a huge market for them.
Massive. China has historically accounted for a huge percentage of ASML sales, particularly in older generation machines. If those curbs tighten further, a significant chunk of their forward revenue guidance could literally be legislated out of existence overnight.
So putting all of these massive variables on the scales, we have a company with flawless financials, a true monopoly, and a 38 billion euro backlog. But we also have insider selling, exhausted technical charts, labor cuts, and a geopolitical tug-of-war threatening their revenue.
It's a lot to weigh.
Let's build the ultimate bull case versus the bear case for the listener trying to make sense of this. What does the best case recovery scenario look like?
The bull case rests entirely on the thesis that ASML is the indispensable gatekeeper of the modern age. They have a complete, undisputed monopoly on EUV and the upcoming High-NA lithography.
I always think of High-NA EUV like trying to draw a highly detailed street map of New York City onto a single postage stamp using a laser beam from a mile away.
That's incredibly accurate, actually.
It is engineering magic, and nobody else can do it. You literally cannot manufacture the silicon that powers modern artificial intelligence without ASML's equipment.
Exactly. No ASML, no AI revolution. Because of that irreplaceable monopoly, the company has issued very strong revenue guidance for 2026, setting expectations between 34 billion and 39 billion euros.
Okay.
The bull case argues that geopolitical noise and short-term chart overextensions are basically irrelevant. You buy the stock because this company owns the toll booth on the highway to the future of technology. And every major player, from TSMC to Intel to Samsung, they all have to pay the toll.
It's hard to argue with a pure monopoly. But the bear case isn't saying ASML is bad company, right? It's arguing about the price tag.
Precisely. The bear case looks at the current reality and says, look, the valuation premium is simply too high to justify the friction. A PE ratio of 50 requires absolute uninterrupted perfection.
And reality is rarely perfect.
Right. You have internal labor unrest risking production delays. You have unpredictable geopolitical export restrictions directly targeting a massive end market in China. The bear case warns that if April 15th rolls around and earnings disappoint even slightly, or if management lowers their forward guidance by even a few percentage points because of Chinese export fears, the valuation multiple will violently compress.
The bottom falls out.
Yeah, the stock could face a harsh continuation lower, breaking right through that 1,172 euro support zone.
So for the listener, it really all comes down to timeline.
It absolutely does.
Yeah.
The outlook changes drastically depending on your investment horizon. Short term, over the next few weeks, I would expect extreme volatility around this April 15th earnings call.
Because of the technical setup.
Exactly. We have a stock bumping against resistance with overbought indicators and dropping volume. It is a powder keg.
But if someone is looking long-term?
Long-term, the structural picture clears up immensely. Commercial production of their next-generation High-NA EUV machines begins at scale in 2027. These are the machines that will unlock the next entire decade of computing power.
Right.
Driven by that 2027 rollout, ASML has set massive 2030 revenue targets of between 44 billion and 60 billion euros. If they hit 60 billion, the current valuation looks like an absolute bargain in hindsight.
Wow. Up to 60 billion. But here's the critical friction point I keep coming back to. How much of that 2030 perfection is already priced into today's 1,270 euros stock price? I mean, if everyone in the market already knows 2030 is going to be massive, aren't we already paying for that growth today?
That is the fundamental dilemma of investing in high-growth tech right now. You are paying a steep premium today for the promises of tomorrow. To sort of summarize our deep dive here, the data we've unpacked points to incredible, monopolistic long-term potential, paired directly with very clear mechanical signals of short-term exhaustion and geopolitical vulnerability. But I do want to remind everyone listening that while we've laid out the technicals, the balance sheets, and the fundamental mechanics, none of this is financial advice. It is strictly an analysis of the information currently available in our source stack.
Absolutely. Our job is to lay out the pieces of the puzzle and explain how they connect, but you have to decide how to build the picture. And that leaves us with this final thought to carry with you.
Right.
If ASML truly holds the only key to the entire future of artificial intelligence, does the multiple you pay today even matter in the grand scheme of things? Or, are we watching the biggest, most obvious tech bubble of the decade waiting to pop right in front of us on April 15th? That's for you to decide.